Hello value investors, thank you for joining me. In today's video we're going to talk about Workday. Remember, Workday's Q1 21 just got reported, so they're already in fiscal 21. That kind of makes a bit of confusion with calendar 2020. So their results were well received by the market. We saw the shares after hours rallying. Having said that, we should put those results in a little bit of context. First, markets have been quite euphoric of late. Any business that has been positioning itself as a SaaS business is being viewed as a new era business and is being rewarded with a large multiple. As you'll see in the video, I have a question mark about its ability to come out of 2020 or their fiscal 21 particularly strongly, because you can see that revenue growth rate is kind of declining slightly. On the other hand, you should bear in mind, yes, their customers are locked in, so you can say that argument as well. Then I would put another question, and the question, how positive is that revenue? So I talk in the video about its professional services, that the gross margin on its professional services is not looking that great. It has even on the non-GAAP metric, it's only at 1%. So you're really just looking at the subscription side of the business to be commanding the large valuation. Also, as we come down lower from the revenue line, the business is still not GAAP profitable. Remember, this is a SaaS business. Most of its cost is in the form of stock-based compensation. So you have an unprofitable GAAP company and you have revenues coming down. At the same time, you have large multiple. So it's not the worst, it's not the most shockingly overpriced SaaS business, but I also have question marks about whether it's really leaving investors with a lot of upside potential. Anyway, without further ado, let's get started. So you can see that its revenue growth rate is steadily decelerating. So for its Q1 result, it was quite strong, but you must remember this is a SaaS business, so a lot of its customers are pretty much already locked in. What matters more is what its ability to grow new deals, because the deals that come in, they take a long time to get organized, and it's really its ability to get new customers in Q3 that I would be most concerned about. If you dissect Workday's revenues, you will see that a portion of it are subscriptions, which is great, that means customers locked in, but a portion of it is what it terms professional services. Workday's professional services are the likes of consulting and training, really the kind of things that you do at the start. So when you look at its revenue here, you have to remember that 86% of this number here, 86%, is locked in. It's the subscription services. And the remainder, approximately 14%, are just one-off fees that come in at the start of each contract. So as you push into Q2 and Q3, they are noting that the deals are kind of taking slightly longer to get confirmed, and that they should be pushing into Q4 or early fiscal 2022. Now, you should think about Workday's professional services has a gross profit margin of approximately 1%. That's the non-GAAP gross margin of 1%. So for all intents and purposes, it's really not very much accretive to the business model. What it does provide is like a lead generation and an opportunity to handhold new customers, but it's not very much profitable. And if you look further ahead for the full year, you will see that they guide for the professional services to be around 500 million. And if you look back to fiscal 2020, you will see that the revenue from professional services reached 530 million. So this means that this high growth company is going to see -5% revenue growth rate on its professional services. So it's kind of really showing the true image of its ability to continue to grow as it goes further ahead. Indeed, as I show here, Workday's revenue growth rate for subscription services, that's where the customers are locked in, is being guided to grow at approximately 19% for fiscal 21. So it's not really something that I would expect to see from a type of business that's described as a high growth business. Remember that the bulk of Workday's thesis is that it's a high growth business. So although it has large GAAP profit losses, it doesn't, investors are really willing to give this company the benefit of the doubt because it's supposed to be growing quite aggressively. Now, if we look back at the comparison between its GAAP and non-GAAP results, I've just included here that most of its costs are really stock-based compensation. So yes, on the GAAP metric, it's unprofitable, but if you add back its running costs, which is essentially its sales force and its management team, you can be non-GAAP profitable. Now, here's the thing. Workday's valuation is not the worst for a SaaS business. It's quite steadily hovering around 10 times sales. Now, given that it's a business that has been able to be part of the new normal, so to say, the ability to be a digital facing business and have low touch economy, one could make the argument that those type of businesses at the moment, amidst all the market euphoria, are being priced at 20 times sales. So in comparison, this business is actually quite cheap at 10 times sales only. On a price to free cash flow basis, this business is not looking that cheap. So if you say that for fiscal 21, the business is maybe coming up to 800 million of free cash flow, this business is really trading approximately 54, 55 times free cash flow. Now, many investors will say that that doesn't matter because the business is growing, etc., etc., etc. But as we already discussed above, its bulk of its cost is it's a share-based compensation that gets added back to cash flow from operations. So it's very, very difficult to see how investors are likely, in my opinion, to have any upside potential. So as I discussed in the video, you have this kind of company that is very common at the moment. It's a business model that is unprofitable, and its growth is kind of like middling. It's approximately 20%, 25%, and investors are paying a very large premium on the assumption that down the road they can turn out to be, at least 10% operating profits on the GAAP side. So it's kind of a tricky investment to make because everyone else is playing that game of looking for these SaaS businesses that can lock in customers and paying a premium for that. So it's not the worst business in the world, it's not the worst investment in the world, but I also do question whether it's really worthwhile chasing this investment further. Hope you found this video useful. Please subscribe, and I'll see you soon.